these are the subtopics: concept, materiality, preliminary judgment, blah blah blah. Okay. Okay, what is materiality? Simple understanding about materiality. Material, it means in substance. In substance, it means that it's significant. Significant to whom? Now, because we are doing audit, therefore it's going to be considered to the auditor. Significant to the auditor. Yeah. So material in substance. Yeah. Right. There is a definition given here for materiality. Usually is associated with the decision made by the user. Made by the user, taken on the basis of the financial statements. So when we look at the concept of materiality here, the auditor applied this in the performance in, in the performance of the audit work on the financial statements. Okay. So that's why you can see here that the user, it relates to the user's decision when it's related to the financial statements. So what is materiality? Okay, according to the definition here, is about the information that is material if its omission or misstatement could influence the economic decision of users taken on the basis of the financial statement. In other words, it means that if, let's say, some information that relates to the financial statement has been omitted or have been omitted, yeah, and it changed the user's decision, then that piece of information is considered to be material. So it means that, let's say, the information is omitted, not included in the financial statement. The user will, after going through the financial statement, the user may come out with certain decision. And then suddenly the user obtained that information, and it has actually changed the user's decision. So that piece of information, before it was omitted, but now be present, become available to the user and has changed. Therefore, that particular information is considered to be material. Another situation would be the misstatement. Misstatement can be due to error or fraud. Yeah? So if, let's say, this error of fraud, error first, yeah, because fraud is different. If the error does not alter the user's decision, then that error is not material. Okay, for fraud, the fraud usually it will be material to the user, because for fraud, the nature, the circumstances that it occurred is already considered to be material. Yeah. So for fraud, regardless of the amount, whether it's small or large amount, it's considered to be material. Yeah. For error, small amount of error would be acceptable to the user. So it might not change user's decision. But for a large error, it can change the user's decision. So these are what we say material amount. Auditor has to use this materiality, yeah, when planning and performing the audit. So this is what I referred to just now. Yeah, we are going to look at materiality in planning, and we are going to look just in brief in relation to the performing the audit. But in audit, first of all, when the auditor is going to plan, the auditor has to consider or to make an estimate preliminarily before conducting the audit. Yeah? Because this preliminary estimate of materiality is going to be included in the audit program, has to be considered when the auditor make planning for the audit. So we say pre, it means that before starting the audit and is at the planning stage. So usually it will be the smallest amount of misstatement that could be material to the client's financial statement. So if let's say the auditor consider 5,000 ringgit is actually the smallest amount of material, then any misstatements of amount 5,000 or greater, auditor has to consider that or to take that to be material. For a misstatement that is below 5,000, yeah, for a misstatement that below 5,000, the auditor may accept that, may consider not to be material, not substance lah, not substance, yeah. But 5,000 and above is considered to be material. So when we talk about this misstatement which relates to the amount, yeah, which relates to the amount, it depends on the threshold or the cutoff that the auditor decide whether it's going to be material or not material. And this type of materiality we say is based on a factor, quantitative factor. Yeah, it's based on quantitative factor. For fraud, on the other hand, remember just now I said that misstatement can be of two types, error or fraud. Yeah. So for error, it relates to the amount, but for fraud, although that the auditor has set 5,000 to be the 5,000 ringgit to be the cut-off, but if the amount is below 5,000 and it's due to fraud, then the auditor has to consider that also to be material. Okay, material. Right. So materiality is the smallest amount of misstatement that could be material to the client's financial statement. Not to the client, but to the financial statement here, because auditor is auditing the financial statements. Yeah. So whatever misstatement, auditor has to relate that to the total, to the overall financial statement to determine whether it's material or not material. Right. Then here, we know that because auditor apply the concept of materiality in planning and performing the audit, so we said that of course lah, materiality is the criteria used by auditor, and sometimes accountant too use the concept of materiality, right? The concept of materiality. For example, like calculating depreciation. Depreciation is calculated for all assets, right? For example, like on motor vehicle, building, yeah, we need to calculate depreciation for this asset because this asset they last for a few years, yeah, for a few years, and there will be impairment to the value of the asset or the devaluation of the asset figure due to the usage, due to the so many things lah about the depreciation. I hope you still remember about depreciation, yeah. And then the computer, yeah. The computer, maybe the company, the client company bought for each employee computers, yeah, a set of computer for them to work on. Computer lasts for how long? Maybe 2 or 3 years, yeah, but definitely more than 1 year. However, the amount of computer nowadays, the company can get computer for depending on the situation lah. Some computers about 2,000 ringgit Malaysia, but if more sophisticated, more accessories, yeah, that required, maybe will go up to maybe 10,000 depending on the quality of the computer. So for a 10,000 computer, do you think that the company will depreciate? Perhaps yes, yeah. But for a 2,000 computer or a 3,000 computer, do you think that company will provide depreciation? maybe no. The company may expense off immediately. Because why? Because the amount, 3,000 ringgit is not material. Yeah. But for a 10,000 computer, it's material. So this is where accountant apply the concept of materiality. Right. So also remember just now when I talked about the cut off, the 5,000 cut off, it means that materiality is considered by the auditor, and it depends on the magnitude, yeah, and the magnitude in relation to the financial statements. Some companies, similar size company, similar business, but the materiality to be considered by two different similar size, similar business company may be different in terms of its cut-off level, or we say threshold level. Yeah, one company may have 5,000, another company may have 3,000 cut off. So it depends. It depends on the. It depends on the riskiness. Yeah, the riskiness of that particular company. But we say that the nature, the business are all the same. The size are also the same, but the risk may be different. Yeah. So it means that the materiality is about the magnitude of the misstatement that exceeded the tolerable amount. So we said that the tolerable amount for one company 5,000, but the tolerable amount for another company is 3,000. Yeah. So what the auditor has to do with regard to audit evidence here? It means that if, let's say, in the performance of the audit, not in planning, yeah, planning is actually to consider juga. Planning when the auditor plan, if let's say the auditor at his initial stage, when the auditor discovered that there are areas where auditor need to pay attention, critical, or in other words, material, the auditor has to collect more audit evidence. So that has to be documented in the planning, in the audit program, which we covered in the previous meeting. Yeah? And in relation to performing the audit, this is where the auditor actually, collect uh, um, collect more evidence. That is, the auditor will carry out more audit procedures to collect more audit evidence because the area is considered to be material or risky. Yeah? And therefore, the evidence have to be obtained. Yeah? More evidence have to be obtained. Right. Also, we know that materiality is a relative concept. Yeah? So back to the 5,000 threshold or the 3,000 threshold. Okay, so back to the 3,000 just now and the 5,000 example. So you can see that similar size, similar business, but the level of materiality threshold is different. Because why? Because it is a relative concept. Relative, it means based on certain factor. All right, so back to the slide here. Sorry, baca doa sekejap ya. Okay, back to the slide here. Materiality that the auditor has to be concerned, maybe the qualitative type or the quantitative type. So the qualitative type, it doesn't relate to the amount, but quantitative, it relates to the amount. Yeah? So for example, like fraud just now, fraud is the qualitative factor that can affect the materiality. So how small the fraud is still considered to be material, but big amount involving big amount or larger amount, obviously that's going to be considered as material. Yeah? Right. Another type of factor, a qualitative factor that can affect the materiality would be the consequence of the omission or the consequence of the misstatement. If if the omission or misstatement will result in bad consequences, then that particular item is going to be considered as material. Okay? So it depends on the consequence. So here it doesn't relate to the amount. Uh, Even though the omission relates to a low value item, and even the misstatement relates to small amount, it is still considered to be material if it can bring bad consequences. Example I have here, maybe you can refer to this later. Okay, another qualitative factor that affect materiality is about the misstatement that affect the trend, certain trend. An example trend here is trend in earnings. Yeah, earnings. Earning is income. Yeah. So, so, so you can see here, if the trend of the company, if the trend of the company if the trend of the company here is like the earning or the income is increasing, yeah, increasing, and there is a change to economy, yeah? Maybe because of the drop in the price of the oil, yeah, only a few moments, yeah, a few moments, maybe just about uh, a week or maybe 2 weeks, yeah, and it affect the trend of the earning by, where the trend drops. Then after that it go back, and then steadily, increasing or consistently increasing. So when there is a drop there in the earnings, that that piece of information is considered to be material. Another, the last factor that we are going to look at here is about the disclosure. We know that the companies, they have to comply with the Malaysian financial reporting standard, yeah, when preparing the financial statements. If let's say the company did not comply, yeah, and the compliance is actually doesn't really affect the user lah, yeah, doesn't really affect the user. The user's decision might not change, yeah? Even though that some information is not disclosed. Yeah? But the Malaysian Financial Reporting Standard require that piece of information to be included or disclosed. Yeah? And the company did not disclose. So that piece of information is also considered to be material. Yeah? To be material. Because the Malaysian Financial Reporting Standard is actually the established criteria. So when the auditor audit the financial statement, the auditor has to look at, the financial statements figures, yeah, whether all the figures are in compliance with the Malaysian Financial Reporting Standards. Okay. There is no specific rule or standard actually provided in determining the materiality. Yeah, because materiality is considered to be the professional judgment, the professional judgment by the practitioners in relation to qualitative factors. Yeah? Quali. What about the quantitative measure here? Yeah, or the quantitative factor that can cause materiality. So this is related to the amount. Right? If it exceeded, if uh, if uh, if the material misstatement or the omission is uh, if let's say the material misstatement is actually above the material is equal to the materiality threshold or above the materiality threshold, then that item is considered to be material, or that amount is considered to be material. Yeah? And for the quantitative measure here, usually it will be in terms of a certain percentage and based on certain item. Yeah. Now, what I have in the on the screen here, the basis can be the turnover, can be the profit before tax, can be total asset, can be equity, or can be any other basis. Yeah. And the materiality threshold, here you can see that for turnover 1%, for profit before tax, it can range here between 5 to 10%, and 1% for total asset, equity 1%. So what does it mean? Okay, remember materiality, it relates to the omission, yeah, omission or the misstatement. But the misstatement, remember, excluding fraud, because for fraud, it's not going to be relevant here, because this is quantitative. Fraud, any amount is considered to be material. So let's say turnover here, and the materiality threshold is 1%. Let's say the turnover is 100,000 ringgit. 100,000 ringgit. So in terms of absolute amount, 1% of 100,000 will be 1,000 ringgit. So that 1,000 ringgit is the lowest, the smallest materiality amount. The smallest materiality amount. So if let's say the auditor discovered material misstatement which is 900 ringgit, and the basis used to determine whether material or not for that particular item is the turnover. Yeah. So if 1% of turnover 1,000, so if it's going to be 900, then the auditor consider that that particular information or item is not material. Yeah, not material. On the other hand, if it is 1,200, let's say, and then the material misstatement or omission that has the amount of 102,000 now going to be considered as material. So what's the implication of this? It means that the audit procedure, yeah, in planning, the auditor has to plan that for a 1,200, the auditor has to consider to perform the audit work quite detailed. But for a 900 misstatement, auditor still has to carry out the audit procedure but less detailed. So that's the implication of the materiality. All right. And so at planning stage, the auditor is now going to determine the preliminary the preliminary estimates of the materiality. So the preliminary estimate, it can be in terms of percentage lah. Usually it will be in terms of percentage, not absolute amount. So 1% for turnover, 5 to 10% for profit before tax, and so on. Can this rate change? Yes, because it depends on the auditor. This one depends on the auditor will use the rate here depending on the client's business, type of business, yeah, whether there are issues, inherent issues within the companies of the business client, yeah, and so on. So it is not fixed actually. This 1% is not fixed. It is actually flexible. The rate will be determined by the auditor. Different auditor may have different rates. Yeah? It depends on how that particular auditor perceive the performance of the company, the client company. Hmm? And here we do not have single percentage, but we have a range here. So what does it mean? It means that if let's say the amount exceeding the 10% here, obviously it's going to be material. If it is less than 5%, 10% is 10% or more. Yeah? Okay, for 5%, if less than 5%, it means that it is not material. But if let's say the omission or the misstatement fall within the 5% to 10%, this is where the auditor has to use his judgment, whether to consider the item material or not material, and has to relate to other circumstances that might be prevailing in the client company. So these are the quantitative measure of materiality, is the rate, the percentage of the materiality threshold. Materiality is very important. Yeah, so as I said just now, auditor use that for what? For planning and for performing the audit. And not only that, the auditor has to reflect that in the audit report. Yeah, the auditor has to reflect the concept that they use, that is the materiality concept, in the audit report. For instance here, this is actually the statement in the audit report. Okay, the statement in the audit report. So you can see that the term materiality is used here, that the financial statements are free of material misstatements. So just to introduce to you about the audit report, remember audit report will have the audit opinion, where the auditor will give opinion about the financial statements. And what is important that the auditor has to check is that the financial statements do not contain material misstatement. The implication of that would mean auditor will not be so much concerned about misstatement that are not material. For instance, the financial statements contain contain misstatement, yeah? Contain misstatement. Obviously, it will be due to error lah. Kalau fraud, the auditor has to resolve this, yeah, with the management, yeah, resolve with this management before deriving the audit opinion. So in this particular statement here, it means that the auditor may discover there are misstatement, but the misstatement are not material. It's acceptable. Acceptable because it didn't really change the user decision. So you can see that here the audit opinion or the audit report has to reflect the term materiality here, to indicate to provide reasonable assurance to the user that there is no material misstatement. Yeah. Now this is an example of clean audit report lah. Yeah. But if not clean, the auditor has to say that there are material misstatement. Yeah. And obviously, not material misstatement could also occur. Yeah. So this is actually the importance of the materiality concept and applied when the auditor um, issue the audit report. Right. Um, Now this is about the policy relating to materiality. Policy that the audit firm, audit firm had actually adopted or implemented when auditing the client's financial statement. And this policy statement would be for a certain industry. Different industry, they may have different materiality policy statement. Okay? So policy statement is actually a guide lah to the auditor as to determine the materiality threshold. Yeah? So it's only a guide. It means that for the same company within the same industry, the auditor may adjust this according to the issue that the auditor face with that particular client company. So it doesn't mean that although we have this, the auditor has to stick to this for that particular industry. It doesn't mean that yet the auditor can still change this. So we said that the auditor is going to apply the materiality concept at two different stages. One is at planning stage and the other one is at the evaluating result. Yeah. The evaluating the result, this is going to be when the auditor perform the audit work, which I mentioned to you earlier just now. So at this stage, you can see that the auditor set the preliminary judgment about materiality. That is to set the base lah, yeah, which is example given earlier, 1% turnover. And then the auditor will allocate that preliminary judgment, allocate this, yeah, to the audit segment. To the audit segment, meaning that audit segment is audit item. What is audit item or audit segment? Audit segment is a category. Audit item can be on individual item. So audit segment can be in relation to turnover. Turnover. Yeah, kalau if there are mistakes, yeah, the auditor discovered that the turnover has been, misstated. So the auditor is going to determine whether that misstatement is going to be exceeding at least equal or exceeding that 1,000 turnover. Okay? Sorry, 1% turnover. So, so that is what we say allocate to the audit segment. Yeah? Right. And then at the performing the audit, the auditor, when auditor carry out the audit work, the auditor will get the evidence. Yeah. So the evidence, the auditor will use that to determine if there is any material misstatement. And because now auditor has the evidence, auditor can evaluate that, then and decide on the approximate amount, the best estimate misstatement that the auditor has discovered on that particular audit segment. Yeah, and then different audit segment, maybe different material misstatement. So the auditor will combine everything here to see how serious the misstatements are to the overall financial statement. So this misstatement would be, be a factor for auditor to use to consider the type of opinion that the auditor is going to make, yeah, for that particular client's business or client's financial statements. And sometimes, when the auditor perform this audit work and be able to determine the estimate misstatement, is only for for certain audit segment, and there are more audit segments that auditor has to audit. So if let's say this from the audit work, from the audit evidence indicate that the misstatement that auditor, the estimated misstatement that the auditor discovered are is totally different from the preliminary judgment here, then the auditor is going to revise this. Okay, the 1% here, going to revise that. So this is actually the third stage. The auditor will compare, okay, whatever that the actual estimate combined misstatement with the preliminary, and there would be a possibility that the auditor might revise this figure here. So instead of 1%, it could be that maybe 0.5%. Okay? If it is too material lah, ya. Tapi kalau katakan everything is fine, ya, the estimated combined misstatement here is actually lower than expected, then the auditor can increase this. They can increase this threshold of materiality level. So that's all about the materiality. Any question? Save that later, yeah. Right. So materiality, remember, yeah, is about the substance of the item and how that affects the financial statements. Whether the financial statements still give true and fair view or has changed. Yeah. Right. The next topic we are going to look at is about the audit risk. The audit risk is also an important concept. And you know that audit risk definition is where the auditor gives an inappropriate opinion. Yeah. And the most common audit risk would be auditor give a clean audit report when in fact the financial statements are materially misstated. Yeah. So inappropriate, it means that be careful of the term wrong, yeah, wrong, the term wrong. Auditor give wrong opinion. Uh, when you say auditor give wrong opinion, it can be misleading. Yeah, the meaning of that sentence can be misleading. So the best would be to give an inappropriate opinion. Yeah? That shouldn't be lah. Yeah. For instance, that the auditor check everything, carry out the audit work, and then after that form conclusion, and the conclusion say that the financial statement show a true and fair view. But if let's say the auditor carry out more audit procedures, more audit work, more evidence collected, the auditor would have come out with or decide the opinion to be that there are material misstatements to the financial statements. Okay. So this is what we say the risk there. Okay, the risk. Okay. So the risk auditor give inappropriate audit opinion. Well, in business, there will always be risk. In audit too, will always be risk. Why? Because auditor when perform the audit work, the auditor did not carry out on 100% item. Remember, auditor only carry out on a sample. Yeah. But there are certain audit segment, auditor carry out 100% audit. Yeah, only certain, but not all. So it means that there will always be risk that the auditor might not uncover misstatement, yeah, material misstatement, not uncover material misstatement. So auditor has to acknowledge this risk, yeah, has to recognize this risk. In other words, risk is uncertainty. So auditor has to recognize this uncertainty and risk, yeah. And also, you know that not only auditors do tests on sample, but the auditor is human. There is always a possibility that the auditor make mistake. Eh? So that is another reason. Yeah. All right. So what the auditor has to do here, in all circumstances, the auditor has to reduce this audit risk. Yeah? The auditor has to minimize the risk. Yeah? Minimize. Yeah? Reduce that. Reduce. If auditor cannot eliminate, definitely auditor cannot eliminate, and because there will always be risk. So auditor has to minimize that. But minimize up to what level? To the level that auditor feels safe enough. Yes, safe enough. Because if not safe, there is a possibility that the auditor can be charged in court. So the auditor would try to reduce the audit risk to the level that he is safe that nobody is going to take him to the court. Yeah? He can avoid litigation against him. So it's up to the tolerable level. So in external audit here, to the level, it means that to the tolerable level. So there will be a level that auditor can accept. Okay? So for example, like in examination, okay, audit paper. How many of you think that you can get 100%, 100 over 100 in a test, or 100 over 100 in assignment, or 100 over 100 in the final assessment? Not all, yeah, because you know that it's not possible. It's not possible in audit lah, audit paper. Why? Because audit paper is not objective. It's not MCQ, but contain some structured question which require explanation. So when there's some explanation to be made, then it will not be 100% that you're going to get the mark for the test, quiz, or whatever. Yeah, but if it is all true or false, MCQ, then there's possibility. However, in general, okay, there are some courses that have structured question. So like audit too, yeah, like audit, there are situations that auditor okay, sorry, before that, go back to the courses just now. For example, like audit, audit kalau objective, all objective. Can you score 100? Yes, can, provided you know lah all the answers. You are good at that. 100. So you can get 100. But in structured, may not be necessary. Because sometimes you might not expect that the examiner will also look at your grammar. Yeah, the examiner might also look at your sentence. The examiner might also look at your organization of your answer, and also how tidy your answers are. So if that is the case, then definitely you're not going to get 100% correct. And there are lecturers will definitely not give you 100%. Because why? Because of the grammar. Mostly we discovered that there are issues about the grammar and also about handwriting. Small print, the auditor, the examiner cannot read that particular word, satu je word, which really make the whole sentence not understandable. Yeah. So back to the audit risk here, the audit, when the auditor carry out the audit work, there are areas where auditor carry out 100% audit and the auditor get information because 100% be sure, but not all items. Yeah? Not the complete set of financial statement, the auditor will do 100%. Now remember, because that's why we do sampling. Yeah? So auditor has to minimize that, yeah, to the level that he is satisfied. So back to your courses just now, what would be your target that you are going to achieve? Maybe 80%. Some of you maybe 70%. So the risk here, if 80%, the risk that you would like to face or the risk that you still feel comfortable would be 20%. Yeah, that you are going to get 80%. And the other one that agreed the target is only 70%, it means that he or she can tolerate not to get that additional 30%. So that is what we say to the tolerable amount. Yeah, to the tolerable amount. All right, and then so the auditor has to carry out this audit risk, has to determine the audit risk associated with auditing the client's financial statements. And because risk is actually um, can affect the achievement of the audit goal, audit objective, then the audit profession has, um, required that the auditors to perform the audit, to approach the audit using risk-based, meaning that look at the audit situation, look at the client situation, whether there are risks or no risk. If risk, carry out more audit procedure. The other area, and the auditor will look at the risk. If this area is less risky, then less audit procedure. So that is what meant by the risk-based approach. Yeah. Right. In determining the audit procedure, the auditor has to look at the audit risk model. Yeah, audit risk model. Let's look at the audit risk model. Yeah. So remember, just now, auditor cannot totally eliminate audit risk, but reduce that. Yeah, reduce the audit risk, and reduce to the tolerable level or the acceptable level. Yeah. Read this. Yeah, I'm not going to explain this yet. Yeah, I'm going to explain this in relation to the following slides. Right. This is the audit risk model in planning. Yeah. So auditor is going to use risk-based approach. So auditor has to use the audit risk model, and this is the audit risk model. Yeah, in planning lah. Yeah, AAR, acceptable audit risk. IR, inherent risk. CR, control risk. PDR, plan detection risk. Okay, I will explain to you later afterwards. Yeah. So you can see here that audit risk in planning, yeah, and risk component, that is to determine the extent, nature, and timing of audit procedure for accumulation of evidence. So why we are concerned about all this is actually because we wanted to accumulate the evidence and also to collect the evidence, um, conclusive audit evidence, yeah, conclusive and persuasive audit evidence. The auditor has to consider the audit procedure, and the audit procedure has to be based on the risk. So the audit procedure has to consider the extent, the nature, and the time, yeah, when they are going to perform the audit procedure. Okay, AAR, acceptable audit risk. Yeah. Acceptable audit risk. Yeah. AAR is acceptable audit risk. A, A, R. So we said just now the tolerable amount. So that is how willing auditor to accept the financial statement to be materially misstated. Right. So here, I'll come back to this slide later. Yeah. Okay. Remember the formula just now, this is for planning, yeah, for planning. planning the audit. Yeah. And let's look at in general the audit risk model. Audit risk model, yeah, actually we can have something like this. Yang ni memang delete ya, delete. Saya sepatutnya delete that one ya. So this is the audit risk model in general. This one here is actually the audit risk model used for planning. The difference that you can see here, we have additional A, acceptable. And here we have P, plan. Yeah? Because this is for planning. Yeah? Okay. This is actually general risk model. So if let's say we ask you give the audit risk model, you are going to produce this lah. Without this one. Yang ni tak ada ya. This one is not here. So this is the general model ya. AR times CR DR. Okay, what is AR? AR is audit risk lah. Yeah, audit risk. But what is audit risk again? It's giving the inappropriate audit opinion. What is AR? Giving auditor give wrong, the auditor give inappropriate audit opinion. Please remember that. So this AR is equal to IR. What is IR? Inherent risk. And this is the risk of material misstatement occur ignoring internal control. Or it could be that the internal controls cannot capture the risk. Yeah, the internal control memang cannot capture the risk. Because why? Because it doesn't relate to internal control. Yeah, right. What is control risk? The risk that internal control system will not prevent or detect or correct the error or material misstatement. The R, detection risk, the risk that the auditor's substantive test will fail to detect error or material misstatement. Right. So let me explain you this. Inherent risk. Inherent risk in general, it relates to the susceptibility of item to material misstatement. Yes, susceptibility of item to material misstatement. For example, like cash. Cash can be in hand, cash can be at bank. Is cash risk item? Is cash risk item? Cash at bank or cash in hand? Of course, cash in hand is more risky. Yeah, cash at bank less risky, but still it is risky because the money at bank can be stolen, right? Money in hand can easily be stolen. Money at bank not easy to be stolen, but can be stolen by writing a check where the signature can be forged. Yeah, the signature can be forged. So the item, when we talk about money, there is risk attached to money already. Yeah, the risk attached to money. Yeah, so we said that money is a risky item. Yeah, money itself is considered to be a risky item. And we are not talking about internal control. We are not talking about how to control or how to safeguard the cash here. Yeah, it's just that we are talking about the money ataupun gold. Gold. Is it risky? Yes, it's risky. Yeah. Telephone. Your telephone. When we say telephone, is there risk there attached to telephone? Yes. Sama juga in to money. Because if you just put the telephone and you forgot about all that, somebody can, when you were turning your face to the opposite way, then somebody can just simply pick up your telephone on the desk, even that the telephone is beside you. And I'm sure you have seen this in the video, some video in the WhatsApp that they have actually passed around how this thief, cheated on the person. Yeah. So telephone is actually a risky item. What more if the telephone is the latest in the market? Yeah. So that is inherent risk. Another example would be, let's say a business, the client business is IT business. IT business, possibility that, you know, the information technology keep changing quickly, very quickly, right? So that is risk. Risk attached to a company that sell related to information technology. Okay, what about a business of tudung? A business of tudung. Is it a risky business as compared to a business that sell school uniform? The business that sell tudung is more riskier because if it's outdated, then people will not, I mean those who are in fashion line, they will go after the new design, new kind of tudung, etc. But for a school uniform business, will there be risk attached to that uniform? How many years school uniform is going to be like that? How many years? I remember since my school days, the uniform is like that, right? So if you are in business of school uniform, which I intend to, I mean, when I was thinking about opening a business, I'm actually risk averse. Yeah, I don't like to take the risk. Yeah, so it's actually one consideration, but I did not know lah. I did not know whether in future I'll be in the business of selling school uniform or not. Yeah, as compared to selling tudung. I don't like selling tudung because I don't like, you know, going after this fashion, because what happened to the stock, unsold stock, if you sell tudung? But if you sell uniform, less risky. So the nature of the business indicate inherent risk here, or the economy, yeah, and so on. Okay, what about the control risk? Control risk relate to the internal control system. Yeah, the internal control systems of the client cannot detect misstatement, cannot prevent misstatement. So it means what? It means that the client's internal control systems are weak. Or it could mean that the control system are non-existent. Or it could mean that there's good internal control system, but management override. That relates to control risk. So inherent relates to the nature of the business, and control risk relate to the system of the business. Can management of the company control or handle this control risk? Can reduce or not the control risk? Yes, management of the company can control or reduce the control risk. Can management of the company reduce inherent risk? No, although that this is within the company, but management cannot reduce this because it is actually attached to the nature of the item. Huh? But for control, yes, management can control. Can auditor control this? Definitely cannot, because this is not the auditor's responsibility, and this is not related to auditor at all. Okay, what about the detection risk? This is where relate to auditor. Yeah, the auditor cannot detect the error. The auditor cannot not prevent, not prevent, because prevent is with the management. So auditor cannot detect the risk, the auditor cannot detect the error. Why? Because maybe the auditor has not used appropriate audit procedure, has not considered thoroughly what type of audit procedure to carry out. Or it could be that the third reason, the auditor has carried out the audit procedure, but auditor has wrongly interpreted the result, which therefore auditor cannot detect the risk. Okay? So these are the explanation for the IR, CR, and DR. Right. So here, audit risk is going to be used by the auditor. So auditor has to set this risk here to the level we said the auditor must reduce this, right? Auditor must reduce this. Risk will always, audit risk will always be present. But auditor has to reduce this so that he will not be charged by the client in court. If he is negligent, it means that he has not considered this, yeah? He has not been careful in his audit work. So that means audit risk, auditor has to reduce this audit risk. Right. So in order to reduce this, auditor first of all has to determine the tolerable level. What level that he can accept the risk. Yeah. Macam 70% or 80% just now lah. Yeah. So the same auditor may accept the risk to be only 10%, or the auditor may accept the risk to be 20%. So if 10%, that means auditor would be confident about his opinion that he is correct in giving opinion 90%. If the auditor consider the risk to be 20%, risk of making inappropriate audit opinion is 20%, then auditor is only confident 80%. 80% out of 100. So 80% confident, because if auditor consider the risk to be 20%, audit risk to be 20%. So you can see here that this is where the auditor comes in and apply the risk concept, audit risk concept, using this formula here. So in order to reduce the risk, the auditor has to actually consider the audit procedure that he is going to carry out, whether it's going to be extensive or reduced audit procedure. Yeah. And that all depends on the tolerable audit risk. So the formula here, if you look at the formula here, yeah, the formula here, AR is equal to IR, okay, and I'm sure you are good at the accounting equation. So you can bring this figure around. I mean this item around. So if you take DR to be on this side, that is going to be AR divided by IR and CR. Apologize me for the format of the formula. Okay, this one should be actually here, yeah. So when the auditor use this model, by bringing AR, IR, and CR to one side and this one on the opposite side. So this is where now the auditor is going to decide that how much audit procedure he is going to carry out on the client's financial statements. Yeah. So this can be extensive or this can be less extensive. Yeah. So because that is going to be used, yeah, can be used in planning purposes. So that's why, okay, I'm going to go back here. So that's why you can see that here, if you convert that, yeah, it's going to be you take PDR to one side. PDR is going to be equal to what? AAR, AAR divided by IR times CR. Correct? So how different this is with this formula here? They are the same. But now we have to change to this formula because now we are going to use this for our planning. So this is plan. P is plan detection risk. A, acceptable audit risk. All right, everybody. So whatever it is, the plan detection risk here, this will be related to the audit procedure. How extensive or how less extensive this would be depending on here. And importantly, depends on how the auditor decide depending on the level of tolerable for audit risk. Yeah. So this one auditor cannot change because this is the company. But what auditor can change is only this, and then that will affect the plan detection risk. I hope you are clear about that, yeah? So this is other explanation about the risk just now, the IR, CR, and the DR, yeah? Okay, so inherent risk, as I have said to you just now, is about the nature of the item, yeah? Nature of the item, nature of the industry, yeah? So it could be due to the economy, regulation, could be to the legislation, industry, or it could be due to the nature of the business, or it could be due to the integrity of the management. Yeah, the overall integrity within the management. Yeah. Right. These are example. I want you to go through yourself. Yeah, this one. Next, control risk. So control risk, just now I said that it relates to the control element. Yeah. I want you to read these two. Detection risk, this relates to the auditor just now, yeah? And this will affect the planning, the direction, and supervision. Yeah. So at planning stage, the auditor has to consider materiality and risk, and auditor has to include this in the audit plan, which later is going to include in the audit program. So the audit program will be used as a guide, and the auditor will then use whatever that he has considered in planning and to apply that when the auditor actually carry out the audit work. Okay? Carry out the audit work. All right. So the rest I want you to read that yourself. Yeah. So this is the relationship. Yeah. You can go through this, but I would like to explain you about this. Right? Which is later if you see when you come back to this, you can see what I'm trying to explain here. Yeah. All right. Risk. Yeah. So you know risk is about uncertainty. Yeah. And the auditor need to respond to the risk. Yeah, to respond so that the auditor will not be careless, will not be negligent, and this may therefore result in performing high quality audit. So let's look at the audit risk matrix here. Risk matrix here usually be asked here. So be careful about this. Let's study this closely. Okay, let's say on upper side here we have the control risk, and then here we have the that is control risk, this is inherent risk. So here, this is actually the inherent risk, which we can say that maybe medium, this one is, low, this is medium, and this is high. Yeah. So low, medium, high. Yeah. There will be these possibilities lah. Similarly, the control risk, low, medium, high. Yeah. And okay, this metric is used for planning. Yeah? This is for planning. Remember this, huh? This is for planning. Right, so what's inside here? What are these? Now, this is what we say plan detection risk. Yep, plan detection risk. And the plan detection risk can be highest, can be medium, or can be high, or can be even lowest. Right? Lowest plan detection risk. Okay. So let's look at this matrix. If let's say we consider this one, control risk to be very low, the control risk to be very low. What does it mean? Control risk is low. It means that the control system of the client is good lah. Yeah? The control system of the client is good. because the risk is low. So in relation to the financial information, is it highly reliable or less reliable? Yeah, if the control relates to information lah, so you can see that the information are highly reliable because good internal control. Yeah, low control risk, good internal control. So information is reliable, or information are reliable. What about inherent risk? Let's again we take the lowest. Lowest. So what does it mean? That means there is less inherent risk. So if you consider the control risk to be low, inherent risk to be low, do you think that the audit risk will be higher? What is audit risk again? Auditor will give inappropriate audit opinion. So do you think that it will be high audit risk? The answer would be no. Low audit risk. Low audit risk. Because this is low and this is also low. So low audit risk. Yeah, low audit risk. Right. That is actually based on the general audit model where AR is equal to IR times CR times DR. Yeah. Okay. So if control risk is low, inherent risk is low, but why is it? Okay, you go here, tengok sini, and then this one here is highest. This is all plan detection risk, right? Highest. In other words, it means that the audit risk is low. Yeah, audit risk AR is low. Audit risk is low. In other words, it means that the auditor will give appropriate audit opinion. Yeah, because of this situation here. Yeah, this one and this one here. So, do you think that auditor will carry out extensive audit procedure? Is going to? Do you think that auditor is going to plan to carry out extensive or less extensive audit procedure? The risk is low. This risk is low. So, do you think that the auditor is going to carry out extensive audit procedure or less extensive audit procedure? The answer would be less extensive audit procedure. It means that the audit procedure may not be done in detail, but has to be carried out, yeah, but not so thoroughly. Because why? Auditor is confident that the information are reliable. So the auditor is going to therefore plan that the detection risk here is to be highest. Highest, it means that the planned detection risk would be highest. Yeah, and this is in terms of percentage. Yeah, the rate. Yeah. So because planned detection risk would be highest, it means that the auditor carry out less audit procedure. Yeah. Because auditor is confident that there are no material misstatements. Okay, everybody? And the opposite is true here. It will be lowest. Planned detection risk. Plan, it means what? The auditor is planning lah to carry out the audit procedure. So if the plan here is going to plan detection risk is lowest, that means auditor plan to have that detection risk to be very low. Maknanya auditor dare not take the risk to give inappropriate audit opinion. So that's why the auditor is going to carry out more audit procedure. Okay, so this one, I want you later to think about this, yeah? And please make sure you know this audit risk matrix. Let's look at the relationship. Now, this is a very simple relationship. Higher materiality, what does it mean? Auditor has to obtain more evidence. Higher risk, it means also higher audit risk. The auditor also has to obtain more audit evidence. Right. This is the relationship, okay, between the PDR and the accumulated evidence. Yeah. You can see that the accumulated dividends is inverse, and this actually slide is related to this one here. Okay, is related to what's inside this matrix. Okay. Oh, boleh serik je macam ni. Ha, lagi senang. Okay. So you can see here that what's inside here is plan detection risk. So this one, plan detection risk. Okay. Maybe this term is confusing. I know every student confused about this term. Yeah. This is low, risk is low here. Are you going to carry out more audit procedure? Tak perlu kan? Because the risk is low. Tak perlu carry out more audit procedure. But why is it highest? The highest is because the auditor can accept higher risk. The auditor can accept highest risk here because auditor is confident. So what about the evidence here? High, greatest or lowest as compared to this one here? This is low. So evidence would be lowest. What about this one here? High risk. That means this is plan detection risk. But the evidence, highest evidence. A lot of evidence here as compared to the rest of this. This would be the most, the greatest evidence the auditor has to obtain. I hope you are clear about that, yeah? So this actually explain about the table just now, about the relationship between the risk and the evidence. So you can see that when we say inverse, if this is increasing, if this is high, this would be low. That's why we say inverse. Yeah. So these two inverse also, this one is positive. Positive is what? Positive is if this is up, this is increase, this will also go up. And opposite lah, vice versa. All right. Audit risk and audit evidence. We said that high audit risk, high audit evidence. Audit risk, I'm talking about audit risk. I'm not talking about acceptable audit risk. Acceptable audit risk and audit evidence, the relationship will be different. Yeah, will be opposite, will be inverse or negative. Inverse is negative, yeah. But high audit risk, high audit evidence. But if we have here the word acceptable audit risk, relationship between acceptable audit risk and audit evidence, it would be inverse. If this up, this will be down, yet inverse. On the other hand, if let's say it's like this, observe here, up, down. If there is no acceptable there, then if this is up, this is down. This is also up. If this is down, this is also down. So this is positive relationship. Okay. All right. So this is what I mentioned about inherent risk could be due to the nature, to the previous audit. Previous audit, think about this, repeated engagement and related party. Yeah, I'm not going to explain that all lah. Yeah. So that's all for the materiality and audit risk. Yeah. Okay. As I said to you just now, your test will be next week and will cover all subtopics in planning. Now, so now I would like to move on to the evidence. Yeah, evidence. Okay, what is evidence? Yeah, evidence. Evidence and procedure. Audit evidence and audit procedures. Okay, evidence is actually the information that the auditor has to obtain. And how the auditor obtain this? By performing the audit procedures. Auditor has to apply the audit procedures and only the auditor get the evidence. What is the importance of evidence here? Evidence will be used by auditor as a basis to form his overall audit opinion. Yeah? But before auditor is able to form overall audit opinion on the financial statement, the auditor is going to make conclusion for each of the audit segments and that the auditor audited. Right, so in this slide, we are going to look at the type of audit evidence, the quality, the risk, and the evidence. This one is actually we have covered earlier. Tadilah in under the topic audit risk. The higher the audit risk, the greater the audit evidence the auditor has to obtain. And then we are going to carry out the audit testing. This is actually audit procedure. So the first part will be the evidence, then the later part will be the audit procedures. So evidence, as I said, used by auditor to determine whether the information being audited is stated in accordance with the established criteria. What is established criteria again? Remember the audit objective. The main audit objective is to form opinion whether the financial statement conform or not to the established criteria. So what are example of criteria? The companies at the Malaysian Financial Reporting Standards, or whatever information that the auditor has to consider in the preparation of the financial statements by the accountant. Yeah. So it's going to be any information and it's going to be used to reach conclusion. Yeah. So this is just to say that audit, most profession they have to collect evidence. Scientists must collect evidence how? Through research. Okay? Whether, for example, like COVID, they are doing the research, right, about the vaccine. Okay? So when they do research, they experiment research lah tu ya, experiment and they get the result. And if let's say that can be used from the research, it become the evidence that maybe that particular vaccine can be used to cure. I do not know whether cure or going to make it the virus less aggressive. Yeah. Lawyer need evidence for what? To decide on a case. Historian need evidence to understand what happened in the past. Yeah. Okay, in audit here, auditor has to obtain sufficient, appropriate audit procedure. Yeah. What is sufficient? It's about the quantity. Yeah, about quantity. So if more audit procedure, more evidence. Less audit procedure, less evidence. So this relate to the less extensive or how extensive the audit procedures, yeah? And up to what level of sufficiency until the auditor is satisfied, yeah? So it is all based on the auditor's judgment, yeah? It's not strict, there is no strict rule, but it depends on the quality of evidence the auditor obtained and also depends on the experience skills of the auditor. Yeah. So experience skill, the auditor would know whether this is good evidence or less less good, less quality evidence. Yeah. So that means if less quality, auditor has to get more. Appropriate, it means that it can be used for auditor to form the opinion. So that is what meant by the appropriate. How auditor can obtain the evidence? The auditor can obtain this by asking the management or asking the staff. So asking can be what? Can be verbally, or it can be in written, or by looking at the or inspecting the documents. Yeah, so that is the source. Another source would be from outside lah, outside. So if this is from inside, management staff from inside, third parties are from outside. So we said to obtain evidence, the auditor has to carry out audit procedures. What is audit procedure? A specific acts. The specific acts performed by auditor. Specific acts. What does it mean? That means the auditor really have to go out and do the test. Has to collect the information. Yeah. So that is what we say audit procedure. Yeah. So auditor has to go to the company, right. I'm going to stop in a while. Yeah. All right. So physical examination. What is physical audit evidence? This is about this every the company is a manufacturing company, so there are machineries, there are fixtures, there are fittings, yeah, or plant, big plant. For example, kan ada plant dia yang tinggi-tinggi tu dekat field, dekat asset, yeah. So when going there, that means the auditor will get this information, and this information forms the physical examination or the evidence. Yeah, I would like to just finish off a little bit. The rest you can read this through yourself. Yeah, and then okay, this is physical examination. Is it high quality? Yes lah, high quality, because auditor himself go and visit the plant. Yeah, okay. Confirmation. What is confirmation? Confirmation is where the auditor carry out confirmation with the third party to get information. For example, with the bank, the supplier, the supplier, creditor, or the customer. And that's negative and positive. Well, I think I'm going to stop there. It's almost time. Yeah, so I'll meet with you again on Friday. Okay, so we have 2.5 topics more to cover. Yeah, so I guess that's all for today. Thank you very much. And Assalamualaikum.
Doktor.